Good afternoon, everyone. My name is Joe Reed, and I am the VP of the Wealth Management and Impact Investing teams here at Van City. It is my pleasure to welcome you to our webinar that we've entitled, What Our Current Markets Mean. Today's webinar is the last in the series that we put together for Financial Literacy Month. Over the last month, we have covered important topics like estate planning, retirement planning, and investing based on your values. We are grateful that you have taken the time out of your day to join us for these webinars. I'd like to begin by acknowledging that Van City operates on the traditional territories of the Coast Salish people. Where I'm located today, I am on the lands of the Musqueam, Squamish, and Tsleil-Waututh Nations. I'd like to take a moment to pay respects to the elders past, present, and emerging, for they have been the custodians of this beautiful land for generations. Now, before we get going, there's a few housekeeping items that I want to go through. This webinar will be recorded and shared with all of our registered attendees. It will also be posted on our YouTube channel following the event. As such, we have turned off all incoming cameras and your microphones. If you haven't already, please make sure you do follow us on YouTube and our various other social media channels like Instagram, Twitter, Facebook, or on LinkedIn. You can actually find those other webinars I was mentioning earlier on our YouTube channel as well to go back if you weren't able to attend. For those of you that are joining us today via desktop, please note that the banner at the top of your screen. Here you will find a variety of opportunities to engage with us, including the most important one, the question and answer button. This allows you to submit a question at any time throughout the presentation, so don't hesitate, put in your questions, and then we will cover those questions off at the end. With that, I'd like to take a moment now to introduce our guest speakers today. The first is Mark Sheard. Mark is our lead portfolio manager of equities. Mark joined Van City Investment Management in 2021, bringing with him 15 years of investment experience. Previously, Mark spent 8 years at the British Columbia Investment Corporation, and he served most recently there as a portfolio manager for a global active equity fund or global active stock fund. Prior to that, he worked as an investment analyst at the Insurance Corporation of BC and as an analyst at the Toronto Stock Exchange. Mark holds an honors commerce degree from McMaster University in Ontario and is also a CFA charter holder. Our other guest will be Wes Dearborn. Wes is our portfolio manager of fixed incomes, of bonds. Wes joined Van City Investment Management in 2019 and is the lead portfolio manager on all of our fixed income strategies, as well as a member of our investment committee. He previously spent 10 years as a member of the fixed income team at one of Canada's leading investment firms, where he focused on core fixed income, short duration, money market funds, as well as doing foreign exchange trading and hedging strategies. Wes holds a Bachelor of Business Administration degree and is also a CFA charter holder. We know right now that many of you are trying to figure out what you should be doing with the current environment. We're seeing, inflation numbers that have gone up that we haven't seen in generations. We're seeing interest rates that are rising very quickly, and we're seeing the ups and downs that happen on a daily basis in the market. And this can create a lot of uncertainty on what you should be doing. So on this webinar, Mark and Wes will cover, and they will provide, to begin with, an economic and market update. They're going to talk to you about how the fact that time in the market is way more important than trying to time the market. And they're going to also talk how turbulent times like this in the market can actually create some opportunities. We know our neighbors to the south right now are celebrating Thanksgiving, and if any of you are American, happy Thanksgiving to you. But we also know that on the day after Thanksgiving, that's known as Black Friday, and we see a lot of sales that happen in the markets. Well, Mark and Wes will talk about how those opportunities like Black Friday for buying retail products are out there with good quality companies that may actually be on sale now as well. So with that, I'm going to turn this webinar over to Mark, and Mark is going to start the presentation for us. Over to you, Mark.
Thanks, Joe, and hello to everyone on the call. Thanks for joining. As Joe just said, my name is Mark Sheard, and I run the equity portfolios here at Van City Investment Management. And my goal today, along with my colleague Wes, of course, is to make sure not to inundate you with too much information, but instead give you a high-level overview of what has been happening in the markets this year, why we are optimistic about the future, and why you should be, And most importantly, as Joe just said, why it is time in the market as opposed to timing the market that matters. So first off, I just want to touch on the highlights of what has happened so far. And the one thing you can't say is that it has been an uneventful year. When we actually first started putting together some talking points and slides around the market, we weren't really sure where to start. From supply chain issues to the extremely unfortunate war in Ukraine to zero COVID policy in China to massive inflation. I mean, there are no shortage of things to discuss when talking about the markets and what has influenced them this year. But we thought when you boil it all down, there are really three major topics that can summarize the year, which we have listed on this slide. And we'll touch on each of these in more depth during the presentation, of course. But first off, and this is something that affects each of us on a day-to-day basis, inflation has hit multi-decade highs across the globe, which has led to central banks raising rates at a very aggressive pace in an attempt to cool the economy and thus bring down inflation. And at least partially due to this, equity markets have had a down year with most markets in correction territory, which means they've fallen by more than 10%, with really only the oil and gas, sorry, I had my camera off there, with really only the oil and gas or energy sector having a positive return this year. And even bonds, which are generally seen as a safe haven for investors as they tend to hold up quite well during equity market downturns, have had a very rough year. So there have been very few places for investors to hide, and that's made it very difficult, right? The 60-40 portfolio, which is a very common asset mix for investors and holds 60% in equities and 40% in bonds, is on pace for its worst year ever, which really just summarizes quite well everything you need to know about this past year and how difficult it's been. But please don't worry, as there is definitely a very bright light around the corner, and investors that stay invested will be certain to reap the rewards. So, we'll dig in a bit deeper into each of these topics. And if we can just please turn to the next slide, which shows the performance of a 60-40 portfolio through the end of September. And really, investing strategies, they don't get more classic than the 60-40 allocation. By holding 60% of your portfolio in stocks and 40% in bonds, the thinking goes you get the best of both worlds. You get high growth potential from stocks and protection from the more conservative bonds. But for investors who hold this portfolio mix or something similar, this has been a tough year. From the start of 2022 through the end of September, this type of portfolio has lost 27% of its value. So only 2 calendar years, one of which was during the Great Depression, just to give you some context, have even been close. In this portfolio, it is designed for moderate risk and moderate returns. It counts on the fact that while the stock market periodically goes down and the bond market periodically goes down, they rarely go down at the same time. For the past 2 decades, the stock bond correlation has been consistently negative. So in other words, investors have largely been able to rely on their bond investments for protection when equities sell off, but of course, not so much this year. Should returns on both indexes stay negative through the rest of this year, it'll be the first year that both have logged a negative return since the early 70s. Now, before anyone listening makes any changes to their asset mix, it's worth it to remember that asset allocations, they're designed to be followed over the course of many years. I mean, ultimately, the number one thing is to not overreact to short-term fluctuations in your portfolio. I think everyone just needs to be reminded, especially when talking about retirement assets, a year does not a fortune make or break. So the goal is to just stay invested. And this next slide helps drive home why that advice is so important to remember. And what this table is showing is the percentage of time periods where both stocks and bonds were negative, which is the top part of the slide, as well as the times that a 60-40 portfolio were negative, which is on the bottom part. And this goes all the way back to 1976, and it shows it in both months and years. So for example, over a 1-month period, about 15% of the time, both stocks and bonds are negative. And about a third of the time, a 60-40 portfolio is negative over that 1-month period. And so very brief simultaneous declines, they're not unusual as these charts show. In fact, according to this, both are negative about once every, I think, 7 months approximately. But it is unusual to see this relationship last over a longer time period. And that's what is really important to understand. I mean, over the last, 46 years, investors have only encountered a full year of negative losses in both stocks and bonds, about 0.4% of the time, and have never encountered a 3-year span of losses in both asset classes. So again, what this is telling us is that you should never let short-term performance drive your investment decisions, as chances are you're going to make a very unfortunate mistake that'll cost you considerable investment returns. And with that, I'm going to pass it over to my colleague, Wes, who's going to talk in more detail about both inflation and the world of fixed income. Wes?
Thank you, Mark. Good afternoon, everybody. Just quickly on here, I thought we'd spend a few minutes speaking about inflation and subsequent tightening that we've seen from the Bank of Canada and globally, as they've been the primary catalyst for returns in asset classes this year. So, don't have to get too much into it, but obviously inflation has been a big headline. Everybody on this call realizes that, goods and service prices have gone up across the board. If you take a trip to the grocery store, you can see great examples of, the staples in everybody's, weekly groceries going up, from eggs, cereal, milk, you name it, has gone up quite a bit. And this isn't just a Canada story. This is a global story. So the chart here I have on the left of the screen shows global inflation across the major economies. And you can see that generally inflation is rising between 5 and 10% across the globe. Canada's highlighted there, and Canada's at 6.9% in terms of headline inflation currently. And these numbers are, quite substantial. And if you look into Europe, they're seeing double-digit increases. So, even higher than what we're seeing here in the Canadian marketplace. And, as Joe alluded to, these are the highest inflation numbers across the globe that we've seen in 40 years. So since the early 1980s, these are the largest inflation numbers. So, obviously it's got a lot of attention. In terms of Canadian specific inflation, the chart on the right, shows that 6.9% headline inflation. So this is the basket of all goods and services in Canada. And you see it's come down slightly from the 8.1% that peaked just a few months ago. And that's just the move in gasoline prices coming down. Broad-based goods and services outside of gasoline are still rising. And in that other measure there, the gray line, that's the core inflation measure, and that strips out energy and food prices in Canada. You can see that's up over 5%. And when you look at this chart, going back to 2010, these numbers really stand out as being elevated. For the past decade, those numbers of, inflation numbers have pretty much been, either side of 2%. And that 2% level that I have, on there with that red dotted line, that is a very important number, because the Bank of Canada is mandated solely, to achieve a long-term 2% inflation rate. And their primary tool for managing this is the monetary policy rate. So if we get to the next page, so the primary tool for the Bank of Canada managing inflation is their monetary policy overnight rate. And this is a way they can, either stimulate the economy, if inflation is low and the economy is struggling, by decreasing the policy rate, or at times like this where inflation is running hot, they need to restrict economic growth, and therefore they need to increase the policy rate. And just looking back here, where we came from over the past 10 years, coming out of the global financial crisis, Bank of Canada and other central banks have, had slashed their policy rates down to the zero bound record lows that they had never had to use that. And over the next 10 years, from, basically from the global financial crisis to the pandemic, the policy rate in Canada, basically trended around, between 0.25% and 1.75%. So, only increased at 1.5% over that 10-year period. And, based on that graph I showed you on the previous page, they were able to keep it at that lower range because inflation was controlled and remained in that lower, end of that 2% target that they have. Coming into the pandemic, obviously, inflation and economic growth and everything took a major hit at the onset of the pandemic when economies were fully shut down. But as inflation began to tick up, through 2021, the Bank of Canada and other central banks were essentially calling inflation transitory. And based on the past 10 years, they were expecting inflation to subside and go back to that 2% meandering range that it had been in. But as we got through 2021 and inflation continued to move higher and into this year, the Bank of Canada and other central banks began to realize that, maybe inflation is not going to just roll over and get back to that 2% range. So the Bank of Canada did its first 25 basis point hike. And when I say basis point, that's 1/100th of a percent. So 25 basis points is 0.25%. So in March, the Bank of Canada lifted its policy rate off that 0.25% range. And since then, we've seen, a number of non-standard hikes ranging from 0.5% to all the way to 1% that we saw in July. And the Bank of Canada policy rate has gotten all the way up to 3.75%. So just over essentially the last 6-7 months, we've seen that policy rate increase by 3.5%. And you can see that dwarfs any of the numbers that we saw over the past 10 years. And we haven't seen policy rate this high since 2008. And moving to the next slide here. So the Bank of Canada policy rate impacts a number of different, fixed income investment tools, as well as borrowing products such as mortgages, lines of credit, credit cards across the board. And I'm going to get into bond yields here in a second, but one thing that everybody's reading about and is impacted personally is mortgage rates. And mortgage rates at the lows in 2020, a 5-year fixed mortgage rate got as low as 1.7%. Those same mortgage rates in Canada now are at 5.5%. So, a near 4% increase in a fixed 5-year fixed mortgage rate. So, quite a huge increase. And we've also seen increases in the variable mortgage rates. And the variable mortgage rates are based on prime, and prime is a function of the Bank of Canada policy rate. So prime is set higher, but they typically move lockstep in a 1-to-1 ratio. So prime back in 2020 and early 2021, actually prime until earlier this year was at 2.45%. And that was at the same time when the Bank of Canada policy rate was at 0.25%. And as that policy rate has increased, prime has also increased by 3.5% and now sits at 5.95%. So the variable mortgages outstanding have all increased by that amount. And going forward, what's expected, and the Bank of Canada has indicated that its policy rate is likely going to continue to go higher from here, although they've acknowledged that they're getting close to that kind of terminal peak rate with which they can go higher. So they're essentially indicated the Canadian economy that they're getting close to that upper bound, indicating that the numbers that we're seeing in the early 80s, double-digit policy numbers and in interest rates aren't likely to happen. It's more of a issue is how long does the Bank of Canada need to keep their policy rate up at these elevated levels in order to get inflation under control. So when you're looking at the variable rates, looking out to December, the market's expecting a 25 basis point hike from the Bank of Canada, and then in January, another 25 basis point hike. So if those come to fruition, the prime rate could go up another 0.5% over the next couple of months. And the Bank of Canada itself came out just on Tuesday, and so from one of its studies, it put forth some notes suggesting that half of the variable mortgages in Canada, they're only paying interest payments now on their mortgages based on how much the variable prime rate has gone up. So, obviously there's some concerns. For its part, the Bank of Canada is hoping that the underlying strength of the Canadian economy. So consumers are in pretty good shape coming out of the pandemic with savings built up and pent up demand for spending and consuming goods and services. The labor market is also very tight. We're seeing widespread labor shortages, and employers are having to give big wage increases in order to obtain new employees and keep employees from switching jobs. So typically during a economic downturn, a prolonged recessionary type downturn, you see big increases in the unemployment rate. So the Bank of Canada is hopeful that they can engineer somewhat of a soft landing, and that's partly why they've been so aggressive in their policy tightening in terms of the magnitude of these rate hikes compared to what we've seen in the past when they've typically done a 0.25% move at per meeting. And one other note is that typical rate hikes take between 12 months and 18 months to fully flow through the Canadian economy. So, rate hikes that we've just been seeing over the last 6 months won't be fully felt by the Canadian economy, for another, 6 months plus, even up to a year next year. So that's partly why the Bank of Canada has been kind of front loading their rate hikes here as well. So they've just stepped down last month from 75 basis to 50 basis points. So it's likely, the likely thought is that they're going to step down to 25 basis points at the next meeting in December. So they've kind of set that more gradual path of tightening going forward. But in terms of bond yields, this chart here shows bond yields in Canada, and the top chart shows interest rates in terms of percentage terms across various terms to maturity from left to right, going from short to longer. And the green line on the top is the current Government of Canada curve. So essentially yields across all terms to maturity. The red line below that is the curve as of the end of December 2021. And you see that interest rates have gone up quite significantly, more pronounced in the front end. And the chart below that, I should say, is that the bar chart shows the differences in those yields. So essentially the changes from the end of last year until this morning. And you see that in the front end, 1 and 2 year rates have gone up, 3% and almost 3.5% for the 1 year yield. And longer dated yields, if you look out to the 30-year term, they've gone up, about 125 basis points, so 1.25%. So they've all increased quite substantially, but the longer term rates have increased less than the shorter rates. And essentially what the bond market is saying here with the inverted curve is they're suggesting that longer term economic growth is likely to slow here, and over the longer term, the Bank of Canada is likely going to have to cut their policy rate as inflation subsides, and that at some point in the future, that policy rate will be back down more towards their, Bank of Canada's neutral target, which is 2.5%. And just moving to the next page, which shows kind of all-in yields. So in addition to Government of Canada yields rising, we've also seen corporate bond yields increase. And this is as a result of downturn in economic growth expected, which impacts corporate profitability, as well as just kind of the general risk-off tone in the global markets. So all-in yields on government and corporate spreads have increased quite significantly. And this has led to the losses this year that Mark alluded to. And as of yesterday, the Canadian bond universe, which is essentially all government and corporate bonds in Canada, had a negative return of just over 10%. So those are big numbers. And if you look in the global context, the Canadian bond universe only goes back to 1979. But if you look at the global context, where indices go back further, this is the largest year-to-date loss in over 100 years. So, these are big numbers that we're seeing. Part of the losses that have materialized this year, essentially giving back the outsized gains that we saw through 2020, when the Bank of Canada slashed its policy rate to 0.25% and implemented quantitative easing aimed at essentially buying bonds and driving yields lower further out the curve. And we had near double-digit gains in 2020. So some of these losses are a result of giving back and kind of the curve normalizing, if you will, in terms of interest rates. Now, this chart here is essentially the all-in kind of weighted average yield of the Canadian bond universe. And you can see that where it is now, it's up over 4%, which we haven't seen yields at these levels since back in 2008. In 2020, they got as low as, call it 1.25%. So almost 3% higher in terms of where rates are now compared to just over 2 years ago. And, as we look forward, we look at this as a big opportunity for fixed income investors. These are levels that haven't been seen since 2008, as I mentioned. And, going forward, these returns, even if you assume bond yields and credit spreads don't change from these levels, you can assume that you're going to get, these type of yields going forward. And for investors who are currently invested in the market and, have seen these losses on their funds, I just want to point out that yields at these levels currently are much better over the long term for all fixed income investors than if rates had stayed at those low levels that we saw in 2020, just over 1%. Because if they had stayed there, those would have been your kind of long run expected return. So, the near 3% difference between 2020 and now, if you extrapolate that out going forward, even excluding compounding, 3% a year over a 10-year period is quite substantial, and beyond that. So, that's a great opportunity. And I should just point out the, upside and downside risks from here for bonds. So, the bond market is forward looking, and, it's already pricing in what it's expecting the Bank of Canada to do. And I mentioned, another 50 basis points possible from the Bank of Canada over the next couple of months. Downside risk for bonds from here would be if the Bank of Canada went and had to tighten more than that over the next, 6 months, year. And if that happened, that would catch the market off guard in terms of what it's currently pricing, and that would result in more negative losses from here. But the Bank of Canada itself has indicated that they're getting close to that terminal rate. And I think, the bigger question is, how long does the Bank of Canada have to keep its policy rate up here? Not, how high is it going to go? And then the upside for bonds from here, in addition to the yield carry that I mentioned, the upside is in terms of possible capital gains. And this is, if we get into a situation where inflation, does respond to the rate hikes that have already, been happening in Canada and across the globe. And if inflation subsides back down towards that 2% target, and that would allow the Bank of Canada to cut its policy rate back towards that long run neutral 2.5% that it targets in terms of its policy rate. So if that were to happen, bonds would rally from here, and you would get capital gains in and above the yield carry that we get. And before I pass it to Mark, I just want to say that, if you have any questions on the bond products that we manage, or if you want to learn more about GIC rates, which are quite attractive here as well, up at 4.5%, please speak to an advisor at your local branch. They'll be happy to provide you with more information. Over to you, Mark.
Thanks, Wes. So we'll turn back to the world of stocks now. And the left-hand side of this slide shows the performance of major equity markets year to date as of November 1st. And, as you can see, and as we alluded to, outside of a few markets such as the UK and Japan, most are down about 10% or more, with the NASDAQ, which is geared to higher growth technology stocks, falling by the most, although performance in this market has actually improved quite a bit over the past few weeks. And a down market, especially one as volatile as this, it's obviously difficult for any investor. But over the last almost 100 years, the stock market has experienced a 10% plus drawdown in the US about 2/3 of the time. Now, the current situation, it's obviously a unique one, with a lot of macro and geopolitical events that are impacting markets. And like everyone else, I have no idea where the markets are headed over the short term, but we have seen, many market drawdowns before, as well as serious macro events that we've had to deal with, including, a pandemic that raced around the world just 2.5 years ago and continues to impact our day-to-day lives. But, eventually markets rebound, and generally rebound by significant amounts following drawdown periods. Now, looking at sector performance, as you can see on the charts on the right-hand side, there's a major divergence occurring, which is unlike anything that I can remember. Energy was up by about 50%, and it's the only sector in positive territory when looking at the world index. And this is why the Canadian market is really holding up so well. I mean, energy is the main contributor to its performance. So we have just over a month left in the year. Energy, it's outperforming the worst performing sector by more than 84 percentage points. I mean, that's just incredible. There's really nobody out there that would have predicted this at the start of the year. But at the end of the day, I mean, the current volatility and market drawdowns, they're really presenting an unbelievable opportunity for long-term investors to improve returns going forward. I mean, right now, the market's just indiscriminately selling companies for really non-fundamental reasons. As an investor that is much smarter than myself once wrote, I mean, out of crisis comes opportunity. You make most of your money in a bear market. You just don't know it at the time. Now, just moving on to the next slide, and I've already touched on this briefly, but the important thing to realize is that this year, in terms of equity market performance, it's not even close to unprecedented territory. Over the last almost 40 years, the market has experienced a 10% plus drawdown more than 60% of the time. And yet, despite this, it ends the year in positive territory 70% of the time. Even declines of more than 20% happen once every 4 years, while a 30% plus decline occurs about once every 10 years. Last year, 2021, the biggest drop the market had, I think it was about 5%. I mean, that kind of tranquility, that's not the norm. I mean, last year stands out more from a historical standpoint than this year does. I mean, coming into this year, it had been, I think it was almost 2 years, just under 2 years since the index last experienced a correction. So that was really making a 10% drawdown long overdue. And drawdowns, they're really just a natural part of the market and something we all need to get used to, and also something we need to take advantage of. I mean, right now, as I said, everything is on sale. And now just turning to the next slide. A big part of the reason why markets are struggling this year. Oh, sorry. Yeah, this slide is perfect. A big reason why markets are struggling this year is due to the aggressive interest rate hikes we have seen, and Wes just touched on, which is, of course, due to the massive move in inflation. And of course, I don't know what's going to happen over the rest of this year, but I think it's important and really helpful to, again, ask the question of what has happened to equity markets in the past when we've been in an environment such as this. And as you can see in this chart, which is showing past equity market performance of both the S&P 500, which is in blue, and the NASDAQ, which is in orange, after inflation peaked out. And it's only looking at periods where inflation went above 5%. And the results are quite good. We're seeing positive performance occurring within just 6 months of inflation peaking, with continued strong performance out at least 5 years. And a big reason why is due to the fact that markets are generally sell off into the first rate hike, because the market is anticipatory. So by the time that central banks were done raising rates, the market was already back in an upward trend. And that's a big part of the reason why it's so difficult to time markets. You can be exact in every possible data point and accurately predict when inflation will fall or central banks will stop raising rates, but still be unable to translate this into investment returns. So again, it's the investors that just hold on during the downturn that will eventually reap the rewards. But of course, that's always easier said than done. And this next slide is a perfect example of how an average investor reacts over a market cycle. It really isn't natural for people to act rationally while watching the stock market. We have such a fear of regrets and attempt to avoid losses at all costs that we do almost the exact opposite of what's best for us. We sell during market bottoms, which is described in this chart as the point of maximum fear, and purchase during market tops, which is actually the point of maximum risk. I heard an excellent quote once that really stuck with me. Nothing looks cheaper than a stock that is going up. And it's so true, right? We just love to watch stocks go straight up and tend to have regret that we don't own more. While watching a stock go down terrifies us, and we just wish that we didn't own it at all. It's really fighting these inherent biases that is one of the most difficult but important aspects of investing. Now, moving on to the next slide. If we look back at the markets over time, and this chart goes back to early 2009, I mean, investors have always had like a number of reasons to worry about market returns. There's always there's always something happening that can deter us. And the promise of that short-term pain avoidance, it's a very powerful weapon, but no matter what, over time, markets recover and grow. Now, it's very easy to use hindsight now and say that each of these moments was not worth worrying about. But when you're in the middle of it, it really doesn't feel that way. Yet to get this fantastic return, you've had to be able to stay invested through a lot of difficult times. And for myself, this next slide, it might be the most important slide in the deck as it really drives this point home. And what this is showing is that trying to time the market, it makes little sense. Over this 20-year period, which ended in January of this year, the market returned about 9.5%, just under 9.5% per year. But simply missing out on the 10 best days would have cut returns almost in half, as you can see in the second bar from the left. Missing the top 30 days results in a return just slightly above zero. It wasn't the timing, it was the time in the markets that mattered. Unfortunately, the average investor doesn't realize this, and as such tends to underperform the market, as we'll see on this next slide. So despite very strong index returns, the average investor, which is highlighted in red, has underperformed a basic index 60/40 portfolio by about 3.5 percentage points annualized. So on a $100,000 initial investment from the start of 2001 through the end of 2020, that adds up to nearly $170,000 of missed gains. I mean, the problem is that investors are human and humans are very emotional beings, and thus we're very easily persuaded, especially when it comes with the expectation that an action will allow them to avoid a loss. So due to this, many investors will just continue to try and time the market, which as we have seen, has real cost associated with it. And now just moving to our last slide, and we just wanted to add this in as it highlights the importance of having a financial advisor. And what it's showing is the difference in wealth accumulation between households that have an advisor versus those that don't, based on a study done a few years back. And the research shows that households that have an advisor save at almost twice the rate compared to those who don't over a 4 to 6 year time frame. And what's more, if you go over a longer time frame, it's about 4x the advantage. I mean, that's a massive, massive difference. Basically, financial advisors help people increase their wealth, and the longer people have advice, the more their investments grow. And a big part of this is because advisors help clients navigate the difficult periods, as we're seeing now, where returns are negative and fear takes over, by really ensuring that they stay invested and reap, the eventual rewards. And with that, I just want to thank everyone again for listening, and I'm going to pass it over to Graham so we can take any questions that people may have. Graham?
Thank you very much, Mark. Thank you, Wes. I really appreciate all the information that you've provided for us today. A quick introduction. My name is Graham Aldrich. I am a regional manager in our Vancouver and Richmond area. Lots of questions coming through, some really interesting things. Just first, I wanted to, again, thank you for the context that you provided. And I like the transition to investor psychology. I think we're seeing that coming through in some of these questions. As we know, knowledge is power, and hopefully we can boost some of the audience's knowledge through your answers. So without further ado, I will jump into our first question here. And Wes, I'll pass this to you first. So the question that was asked is, can you talk about the effect that high inflation has on my portfolio, and what might I need to consider when I review my investments?
Yep, thanks, Graham. Good question. I'll take it from a fixed income perspective, and then I'll pass it off to Mark. He's got some good points he can make on the equity side of things. But in terms of the overall portfolio, so from a fixed income perspective, we talked about inflation, and that's essentially being the catalyst for the Bank of Canada increase its policy rate, and that ramification has worked itself through bonds, and now bond yields are yielding significantly more than they have been in the past. But the result of bond yields rising is that bond prices go down, so that over that horizon you generate capital losses that offset kind of the normal yield carry that you get from bonds. So the result being on the fixed income portfolios is losses as a result of the Bank of Canada having to raise rates to defend against inflation. And the The downside that I talked about is that if inflation stays up here for an extended period, it looks like it has peaked, but if inflation doesn't kind of go back to that 2% level, Bank of Canada is going to have to hold this policy rate up at elevated levels, a lot higher than we've seen, especially over the last decade. But the bond market's forward looking, so it's already pricing in some of this. So, unless we get more increases from the Bank of Canada, the capital gains that we've already seen have already been front loaded. So, I talked about it. It's, an opportunity going forward from where yields are, the starting point today, and even reinvestment. So in terms of a bond portfolio, you think of an existing bond portfolio that's realized some of these capital losses going forward. Any coupons that come in semi-annually from nominal bonds or maturities, these coupons and maturity amounts are going to be reinvested at these higher levels. So going forward, you're going to get the advantage of the higher rates. And if you extrapolate that out, these higher yields are significantly better for everybody on the investor side over the long run than where we were back in 2020 when we had those outsized capital gains. But that left yields down just over 1%. So, we're in a much better position now. Hopefully that answers something on the fixed income side. I'm going to pass it over to Mark just to touch on what he's seeing on the equity side and some of the opportunities there.
Yeah, thanks, Wes. And it is an excellent question. So from an equity market standpoint, there's a few ways that it'll impact your portfolio. I mean, the first, and this is really due to the fact that interest rates are rising to combat inflation, right? And I'll try not to get too technical, but what happens is that when interest rates rise, people are basically willing to pay less for a dollar in the future. And so what you see from a stock standpoint is that the valuations or the amount that people are willing to pay to purchase a share of a company, that goes down. So maybe before interest rates started rising, they were on average paying 15 times a dollar of earnings. Interest rates start to rise, and there's an opportunity risk there, right? Because you can make more money through bonds. So people are willing to spend less to buy $1 of earnings out of a company. And so this year, and again, I'll try not to get too technical, but what's driving the equity markets down, it's not a drop in earnings. In fact, earnings growth for companies, it's still positive. It's just the amount that investors are willing to pay for a dollar of earnings has come down. So all the companies, their valuations have come down, which we call a derating. And that's actually a very, very positive sign because the companies are actually still growing underneath. So the other way that it can impact your portfolio is at the actual company level. Inflation is hitting corporations just as much as it's hitting you and I. And historically, inflation tends to hit via commodities. So it could be agricultural products, it could be metals, it could be energy. But this year, it's across the board. We're also seeing a lot of wage inflation, and there's a lot of positive to that. And it's something that probably should have happened years ago, to be honest. But it's not just the cost of goods that is increasing for companies, it's also the cost of labor that's increasing. So it's really hitting corporations, across the board. So how do you defend against that? You invest in companies that are able to pass on those increases. And so what you want companies that have what we call pricing power. This is actually part of the process that we have here at Van City when we're looking at a company. We want companies that provide mission critical products and services and thus have pricing power. Now, can a company match inflation this year as easily as they could last year? No, it's going to be more difficult. When inflation hits 9%, maybe you can go 7 or 8. When it's 2%, though, it's much easier for these types of companies. So it's very easy to protect yourself in times like this. And again, just a reminder that during inflationary periods, the equity market still tends to rise. So don't be too concerned about inflation in terms of your portfolio. I do think a lot of the damage is already in our past. And as Wes said earlier, I think there's a lot more risk to the upside going forward. But I hope that answers your question.
Yeah, both of you, thank you for that. One thing I heard from both of you amongst the numerous tidbits of information was a focus on quality, whether that's the coupon, the regular interest payment you've received twice a year through the bond that you may hold in your portfolio, or that stock, the equity holding. Now, that actually is a perfect segue into the next question that's come through. And I think it's an interesting one. You are both portfolio managers, so you are responsible for looking after other folks' money. The question is, how do you manage downside risk in your portfolios? And I'll explain for the audience. Downside risk is the risk of a prices or the value of a portfolio, excuse me, falling. Maybe Mark, I can start with you, and Wes, feel free to jump in here as well.
Yeah, thanks, Graham. So downside risk is something, to be honest, that we think about all the time, whether the market's going up or down. It's best to be prepared, obviously, prior to an event occurring. And it's a big part of the reason why our process from an equity standpoint, again, we try to invest in companies that we consider to be of very high quality. So we want companies that provide those mission critical products and services that, again, have that ability to pass on price when needed, that don't take on a lot of leverage. There's only so much you can do, of course, because we can't predict the future, and every downturn is different. And I would say that the current one in the equity market is very unique, as energy greatly outperforms every other asset class. But if you look back historically, again, just focusing on the equity market here, at past downturns, what has outperformed tends to be high quality companies. And again, it is just for those reasons that I touched on. So, there's other ways that you can kind of ensure that you can at least try to do better than the markets. And I think that's one way, but another is also to make sure that you're well diversified. Again, from an asset allocation standpoint, this year, again, very unique, but a portfolio that holds both equities and fixed income, of course, should do better during downturns. And even if you're just looking at your equity portfolio, I mean, you don't want to put all of your eggs into one basket, right? You want to make sure that you hold enough companies, hold enough different types of companies, well, different business models, I should say, that you don't get too hit too hard when one of those business models, falls for something that is unforeseen. And again, just remember, the future is not ours to know. The market and its future is very unclear. So you do the best you can to try to protect yourself. But there's really only so much you can do. So diversification is a big part of what should be a big part of anybody's investment process. Wes?
Yep, thanks, Mark. Yeah, so in terms of fixed income portfolio, it's a little different than equities. Interest rate risk is a big one. And predicting interest rates is extremely tough, especially, when you see moves like this. These are, unforeseen moves that can be predicted. But interest rates, typically what we can do is, in terms of bonds, the longer term the bond is, the more sensitive it is to interest rates. So as rates go up, the larger price declines are on longer dated bonds. So, one thing we do when we, get a sense that, interest rates may start to move higher, we can reduce our what's called duration risk, which is interest rate risk on the portfolio, and shift to shorter dated bonds. There's also stuff we can do on the yield curve, depending on the shape of the yield curve based on, that chart I showed you, it's inverted now. And there's certain points of the curve where we can be strategic in terms of where we think it's a bit more defensive in terms of positioning. And then on the credit side of things, credit spreads typically in an economic cycle, as the economy is expected to deteriorate, credit spreads will widen out. And that's what we've seen through this cycle. So, as that expects to happen, as we see that happening, we can reposition, within our credits, and especially the credit quality. So, triple B is kind of the lowest investment grade quality we'll invest in. And those ones will perform the worst when you're going into kind of a slower economic period, and then they typically perform the best when you're coming out of that. So we're able to kind of navigate around those positions, through our actively managed portfolios. The other thing I want to mention is that, kind of what Mark's already touched on, but markets are extremely forward-looking. So, everything we're already talking about, possible economic slowdown, interest rates, possible more hikes from the Bank of Canada over the next couple of months, markets are already pricing this in. So, unless we get something different than how it plays out, it's already being captured in market prices. And if we get something different from, a positive, then we'll see a reversal of that, and in both for stocks and bonds. There's a lot of bad news, if you will, priced into the market currently.
Lots of excellent information there. Thank you both for that. Another really good, I think, segue here, and maybe I'll lump these two questions together. So the first question is, if we are going into a recession, should I invest now, or is it better to invest later, better to wait, or invest when the markets go lower? And I'll tack another one on here, and it's speaking to GIC. So since markets are performing negatively this year, aren't GICs a better option for me? Maybe Mark, I can start with you again.
Sure. Thanks, Graham. And to be honest, this is a question I get quite a bit, not just at work, but from friends and family. So obviously top of mind for a lot of investors. My answer is it's always, there's never a bad time to invest. You're never going to pick a bottom. And if you think you are, I'm sorry, but you're wrong, unfortunately, and it's just an impossible thing to do. You might get it right once, but it's not something you can do over and over. And the big concern is that if you are trying to time the markets, you could possibly miss some of the best return days. And like that chart we showed earlier, it only takes missing, say 10 of the best days of the last 20 years where your returns get cut in half. So you're trying to time the market. It really is the worst possible strategy, that I could think of. Now, when somebody puts money into the markets and then the next day it falls, what's the first thing they think is, oh, if only I'd waited a day. If it falls over the next month, it's the same thing. If only I had waited. You're never going to pick the best time to invest. So the only thing you can do is invest and then try to ignore the movement of the markets on a day-to-day basis. Now, a lot of this comes down to the fact that when I'm talking about this, I'm expecting that everybody has a time frame that is a bit longer than a quarter, 6 months, or even a year. Now, if your time frame is shorter than that, then please do not follow this advice, because I don't know what's going to happen over the next 12 months. Everything that we're saying is dependent upon the fact that you have a time frame that is longer term. If you're thinking short term, then the equity market is not for you. If you're saying what's going to happen over the next quarter, like I have no idea, as does everybody else. And there's really no point in even trying to guess. But my answer to everybody that asked me that question really is that there's no bad time. And the interesting thing too is when we get back to the idea of investor psychology, if you went back a year when the market was still performing quite well, it was much easier, or I should say, I got a lot less question from people about whether or not they should invest because they just were investing. The market was going up, they felt confident, they were putting money to work. Now the equity markets are down 20% plus, and now they're concerned. But everything is now 20% plus cheaper than it was back then. And there really isn't any major structural changes for most of the companies out there. So it's just, I think it's really good to be aware that, right now, prices and the future returns, they're looking very good. And just to kind of answer the very last part of that question, Graham, in terms of whether a GIC is a better place to be, I mean, again, it comes down to your time frame. If it's less than a year, buy that GIC, you go into a high interest savings account. If it's longer term, you're always going to be better off invested in the equity and fixed income markets. Wes, I don't know if you want to add on anything to that.
Yeah, thanks, Mark. I can just kind of quickly highlight some differences between GICs and like a bond investment in one of our bond portfolios. GICs, especially at these levels, are a great tool. If you can get 4.5% over a one or multi-year period where you have a fixed term where you want your proceeds of your investment by a certain date. And you can get this 4.5% without any worries about the market. That may be a great resource and tool for some people. If you have a longer horizon, just as Mark talked about, or you have some uncertainty around if you need the funds in terms of liquidity, the bond pools that we manage provide instant liquidity in terms of you can get your money out within a couple days notice through your advisor, whereas a GIC, if it's a fixed GIC, there's consequences to breaking the GICs early. So the other, I guess, upside / downside, as you will, is in a bond pool relative to a GIC, you get the sensitivities around the capital move. So if you buy into a bond portfolio relative to a GIC and interest rates go further rise from here, you could potentially have some capital losses. But as we talked about, there's more upside to downside in terms of bond prices from here. So if over that horizon bond yields go down further, bond prices go up, there'll be some capital gains in addition to the yield that you get from the bond pool relative to a GIC where that, the value of your GIC stays constant over that term and you receive income based on that rate that you lock into at the time of the investment.
Excellent. Thank you both. I just want to reflect very quickly before the last question. Mark, I believe it was you who had said earlier, you focus on time in the market, not timing the market. And I really think that's an important message to reiterate as we're trudging through these interesting days. The last question, and I think we would perhaps be remiss if this wasn't asked, it's on crypto, of course. And the question is, what impact will the recent drop in cryptocurrencies have on either the current economic situation or the overall financial markets? I don't know who would like to take that. We can do rock, paper, scissors for that. Mark, go ahead, please.
Yeah, I could start, and then if Wes wants, he can jump in afterwards. So one thing I just want to say first is that at Vancity, we do not invest in cryptocurrencies. We have, we're not even in the products or services really that are kind of on the sideline of crypto that are helping the industry get started. So there's no impact, obviously, to our portfolios, our holdings. I'm sure a lot of people have seen the recent news of what's been happening with FTX and the bankruptcy that's occurring and potential for that to go into other areas of the crypto industry. I mean, to be honest, it's a sideline story. It's a fascinating story. I'll be honest. I've been a little bit hooked to it myself. But it's not something that is structural in nature in terms of the overall financial industry. This industry is fairly new, and like any new industry, even ones that have done well over decades, there's going to be winners, but there's going to be a lot of losers. If you think about any successful industry, think about personal computers, think about automobiles, there's 2 or 3 companies that end up taking the lion's share, and then dozens, if not hundreds of companies that end up, to be honest, going nowhere. I don't have any personal opinion on crypto, to be honest. I don't really have much of an opinion on the industry. To me, it's too speculative for me to invest in. There's a lot of great opportunities out there right now. There is zero reason, I think, for us to focus on crypto, but I understand that this is something that's hitting the headlines and is really fascinating. But to be honest, it really has very little impact, if any impact, on the financial industry, and hopefully very little impact on everybody's portfolios that are on the call today. And Wes, I'll hand it over to you if you have anything else.
No, that's a good summary. If anything, you could see people who have been in any of these investments who have lost money. This could spur them to go back into the traditional investments that we've been talking about. So with that, I will pass it off to Joe to wrap it up.
Thanks, everyone. Thanks, Wes and Mark, for this. I think, as both Mark and Wes alluded to, one of the most important things that maybe you take out of this is actually sitting down with your advisor. These are challenging times, and challenging times will affect everybody in a different way. And the key part to understanding exactly what Mark and Wes were talking about is understanding how it affects you. And that's where your advisors can come in. So I would encourage you to reach out to one of our Vancity professionals. We will actually have at the opportunities that you can go on, and we will send an email out, and there'll be a link where you can actually book a meeting with an advisor if you so choose. But these are the times when having that second set of eyes, or having that individual who can work with you to understand what your core values are, your core goals are. Are you saving for a long term, as Mark was saying, or is it a short-term investment? So again, I would encourage you to reach out to an advisor. If you missed any of the other webinars that we had previously, do go onto our YouTube account and you can see them there. And I want to thank everybody. First of all, thank our presenters, but I would like to thank everybody for coming out today, and have a great rest of your day. Thank you very much.